Banks look safe and simple from the outside. You deposit money, withdraw it when needed, maybe take a loan someday. But behind that simplicity lies a powerful system that quietly generates billions. To understand how banks really make money, you have to understand that banks don't just store money, they use it. When people deposit cash into a bank, the bank does not keep that entire amount locked in a vault. Instead, it keeps only a small percentage as reserves and lends out the rest. This system is known as fractional reserve banking, and it is the foundation of modern finance. For example, if you deposit $1,000, the bank may keep only a fraction and lend the remaining amount to someone else as a loan. That loan is spent, redeposited into the banking system and lent out again. In this way, banks effectively multiply money in the economy. The primary way banks earn profit is through interest. When you deposit money in a savings account, the bank pays you a small interest rate. But when the bank lends that same money to someone else as a mortgage, business loan, or credit card balance, it charges a much higher interest rate. The difference between what the bank earns and what it pays is called the net interest margin. This spread is one of the biggest sources of bank income. Credit cards, in particular, generate enormous profits because interest rates can be very high, especially when customers carry balances month after month. But interest is only part of the hidden system. Banks also earn billions through fees. Account maintenance fees, overdraft fees, ATM charges, wire transfer fees, late payment penalties. These small charges may seem minor individually, but across millions of customers, they become massive revenue streams. Investment banking divisions earn money by helping companies issue stocks and bonds, managing mergers, and providing financial advisory services. When large corporations go public or raise capital, banks take a percentage of the deal. Trading desks within major financial institutions also generate income by buying and selling currencies, commodities, and securities. Another powerful source of bank profit comes from money creation and central banking relationships. In countries like the United States, the central bank, known as the Federal Reserve, plays a key role in controlling interest rates and liquidity. When the Federal Reserve lowers interest rates, borrowing becomes cheaper and banks can issue more loans. When it raises rates, banks often increase lending rates faster than savings rates, widening their profit margins. During financial crises, central banks may provide emergency funding or stimulus programs that stabilize large financial institutions. This close relationship between commercial banks and central banks is a crucial part of the modern financial system. Banks also invest money directly. They may purchase government bonds, corporate debt, or other financial instruments that generate returns. Large global banks operate internationally, earning from foreign exchange transactions and cross-border financing. In addition, banks bundle loans together, such as mortgages, and sell them as investment products. This process, known as securitization, allows banks to free up capital and issue even more loans, increasing potential profits. However, when this system becomes too aggressive and risky, it can contribute to financial crises, as seen during the 2008 collapse. Despite their profit-making power, banks operate on confidence. If customers suddenly lose trust and withdraw their money all at once, even a large institution can collapse because most of its funds are tied up in loans and investments. That is why governments ensure deposits and regulate banking activity. The system is designed to balance profitability with stability. In reality, banks make money by turning deposits into loans, charging interest spreads, collecting fees, leveraging central bank policies, and investing strategically. It is a complex but carefully structured system that quietly drives the global economy. Understanding how banks truly generate profit reveals that they are not just safekeeping institutions, but powerful financial engines shaping the flow of money worldwide.